Good morning, everyone, and welcome to this morning's webinar. I hope you can all hear me there. Before we get started, I just want to confirm that if you've got any questions during the webinar, please feel free to post them in the chat box, and I'll try and get round to answer those at the end. Also, if anyone's experiencing any technical difficulties throughout any of the presentation, don't worry, this is being recorded, so we'll send out the link to the YouTube page after the presentation. You can watch it again at your leisure. So good morning again. By way of introduction, I'm Alessandro Sidoli, otherwise known as Ali, and I'm an insolvency practitioner in the corporate recovery department at K. Johnson G. I know a few of you on the call have worked with me before, but for those of you who haven't, a little bit about myself. I joined KJG nearly 2 years ago, and have been a qualified IP for the past 7 years, dealing with both corporate and personal insolvency. I sit on the licensing committee at the ICAW, which effectively deals with the quality control of IPs licensed by the Institute. And I'm also part of the team at KJG that won the Insolvency Firm of the Year last year at the National Insolvency Awards. So why are we here today, and what are we discussing? Well, after several years of people talking about the uncertainty about the impact of the B word, we seem to now be moving on to the uncertainty of the impact of the C word. I'm going to be identifying the potential threats being faced by companies in the short to medium term due to the effects of COVID on the economy and the trading environment. But then we'll be turning to practical protection for companies that they should be looking to implement, and also the more formal protection offered by the Insolvency Act and new legislation brought in by the government under the shorthand SIGA, Corporate Insolvency and Governance Act 2020. And I'll try and speak a bit longer as well about those new measures that have been implemented and brought in by SIGA to try and give some further information to those who who may not be so familiar with them. So threats. I think the biggest threat, obviously, that we're talking about at the moment to business is what's been happening for the last 4 years, and that is uncertainty. A prime example of it, not done by me in preparation of this presentation, but is the government's response to the small outbreak in Spain of more COVID cases. Unexpected but immediate action. Quarantining those returning from Spain, and I'm expecting something pretty similar in the business environment in the coming 6 months to the year. We don't know when there's going to be localized versions here in this country. Leicester a couple of weeks ago, but it's something that can't be planned for by companies, but will have devastating effects on companies that are already trying to recover. I'll give one example of a client who came to me late 2016, just after the Brexit vote, who was an importer of mechanical parts. The actual Brexit decision hadn't had an impact on their business, but the fallout of Brexit and that on the exchange rate at the time and the plunge that came after the Brexit vote meant that he no longer had a business. His margins had disappeared overnight on the imports that he had, and he had to close his company down by way of a liquidation. All to show that uncertainty can be a killer of companies that depend on things that may well be disappearing. So what are the more likely threats to be being faced by all companies out there? Well, new and challenging marketplace, I think that's just a nicer way of saying things are going to be uncertain for a long time. The bigger point here is going to be there's going to be an impact on consumer and customer confidence going forward. The reality is we are a nation of shoppers. But I don't feel people have the confidence to be going out there at the moment and spending that money. A bigger point for a lot of people out there is going to be that a lot of people are on furlough, and although the government is bringing in the incentive to try and keep on these people to at least January, what does that mean for businesses when they get the other side of January? Are we looking at a massive redundancies coming then? And I think a lot of people in those positions, in furlough or in sort of businesses that aren't potentially performing as well, aren't going to be wanting to be spending as much, which just means there's going to be less money moving around the economy, coming into companies and businesses for them then to sort of pass on down the chain. So that in turn leads to income reduction for the businesses, and also cash reduction in the businesses. And as I'll go on to say in a couple of slides' time, cash is going to be so key when dealing with recessions and dealing with recovery. So the fact that less of that is going to be coming into businesses is going to be a challenge and a threat in of itself. The government assistance, although a lot of people have praised the government for the way that they responded in terms of the actual schemes they put in place with furlough and the grants that came through through the councils for the business rates. Everything else that's been offered by the government has been debt in one way or another, whether it be the interruption loans or the bounce back loans. Not that that's a problem, but it's a problem for businesses that have to be in a position to repay that going forward. I know the bounce back loans, the interest is frozen for a year, etc., but it's still a factor that companies are going to have reduced incomes but higher expenditure. They're going to be higher geared going forward now, which is just a threat in of itself when you look at a balance sheet of a company. Increased urgency on payments. What do I mean by that? I think, unfortunately, what we're going to see over the coming 6 to 12 months is some of the bigger names in different industries fail in some way, which is going to increase the bad debt on a lot of companies further down the chain that use them as large customers and are relying on them for the payments to be coming in. So all effectively is going to happen. There's going to be a tightening, and people are going to be expecting payments to be made quicker. And there's going to be a real incentive, again, coming back up to the top about cash. And it's going to be a real sort of fight to be who can keep the cash in their business and who can be sitting on the most cash effectively. And then implications of the new legislation. So this is specifically talking about CIGA 20 and the moratorium and the arrangements and reconstructions that have been brought in by CIGA. Again, I'll go into those in a lot more detail later, but effectively, secured lenders are going to be less forgiving of defaults. I think going forward, we're going to see a lot more, a potential for a lot more action by secured lenders, not wanting to be subject to what's being called the cross-class cramdown under a reconstruction or arrangement. Again, I'll explain that a little bit later. They're going to want to keep control of situations rather than handing it to directors, which effectively means they're going to be wanting to take action earlier and, like I said, be less forgiving of those defaults. And then just there under the picture of the looming cloud, Brexit. So what has been going on for the last 4 years is effectively coming to a head in the next 6 months. We will have a trade deal or we won't. So effectively that added uncertainty at the moment isn't helping the situation for companies that are trying to plan for the medium term as their sort of response to COVID and their recovery from COVID. I suppose as a worst case scenario, businesses are looking at the WTO terms and what that means for them at the moment and the guidance the government is giving on that. But effectively, I think if we the businesses plan for an increased price on imports, it's not going to be far wrong from what the reality is going to be for them. And I suppose another sort of anecdote before I move on to the sort of practical steps companies should be taking. I'm seeing a lot of companies at the moment, profitable companies, solvent companies, that are actually sitting on a lot of cash, taking the decision to close now. And these aren't companies that need to. They're trading fine, during COVID. But one of the threats I've identified there in terms of the government assistance having to be repaid, the tax, obviously the people are expecting going forward. A lot of companies being run by people in, say, their late 50s, early 60s, just to give an example, are saying they'd rather check out now with that cash that's in their business than try and trade on another 5-10 years to get to their retirement age, because they don't know what the corporate tax regime is going to look like going forward. And effectively, they'd rather take their earnings now and close it down by way of a members' voluntary liquidation to get the money out as capital rather than income, and then try and use the entrepreneur's relief on that, and then live on that for the next few years until they get to their pensionable age. Because, as I said, they don't know what the corporate tax or the personal tax, income tax, is going to be looking like for the next few years by the government's trying to reclaim as much money as possible for all the support they've given. So effectively, they're hedging their bets and not wanting to slog away for the next 5 to 10 years for little or no reward compared to where they are now, which I think has actually been quite an interesting assessment by those people. So what practical protection can we look at for companies? And again, a lot of these are going to be actual basic things, but I think sometimes when you're caught in the eye of a storm, they're not the things you're necessarily concentrating on, because everything's about making sure that your business is trading tomorrow rather than trying to make sure that it's trading in 2 weeks, 3 weeks time, or sorry, 2 or 3, 4 months time, years, we're talking about here. And as I sort of alluded to in the previous slide, cash is going to be king. You just have to look back to 2008 and the credit crunch. Cash was always going to be the most important thing in your business. I think as a result of that, one has to incentivize cash payments as much as possible. There needs to be, as I say a bit further down the slide as well, a reduction in credit terms being given out. And yes, it may mean that there's some sort of incentive there for reduced credit terms or for cash payment. But at the same time, if one can make certain you're receiving cash rather than sort of giving out a lot of credit out there that has the potential to, it looks great on the balance sheet with the debtors due in, but there is a lot of scope for bad debtors in this current economy and this current climate. I don't think any business is safe from that. So the more you can get in cash and deal in cash, the better prepared I think you're going to be for any of those localized shutdowns, any of the weaker trading periods, a weaker Christmas if you're in the retail industry. So I definitely think that you don't want to be relying too much on your customers adhering to their credit terms when they may well be in a worse position than yourself. Stock assessment. Again, this is a very old adage about how to run a business, but should really be looking, if you are a company that holds a lot of stock, whether any of it is getting older. Is it less used out there? And again, can it be sold on bulk? You're probably not going to realize a lot of money if it's old stock or stock that's not regularly used, but at the same time, you're using up capital in terms of product and warehouse spacing, as well as the fact that you may realize some sort of pot of money that you didn't realize you really had for something that you're not even using. And again, it's not an assessment you're probably going to do outside of taking specific time to look at that and see whether there's potential there to realize some money from it. New opportunities as a practical protection. So, a good offense being a good defense sort of thing. One accountant I've been speaking to recently has told me a story about one of his clients who is a fine wine retailer in West London. Didn't have a website. Were very niche in the wine that they did provide, with it being very fine, but they had a very loyal following. And the moment that COVID hit, obviously they had to close their shops, couldn't be open. They were facing the prospect of not having a penny's income for however long, the restrictions were going to last back then in March. But what they did, they immediately identified the fact that they had a very loyal following who were still looking to purchase from them. So they made the immediate outlay of a website, of a commerce, an e-commerce sort of ability on the website as well. So what they've been able to do is continue to supply that wine through online ordering. Again, I know this sounds like a very basic point, but there's a lot of businesses out there that still rely on footfall as their main way of making business. But the reality of this wine shop, they've actually ended up having their most profitable quarter ever as a result of making that step, going online, because they've been able to turn that loyal following into sales. And actually, funnily enough, they've been able to do that with reduced outgoings because the rent's been able to be renegotiated. So what was probably a very catastrophic position for them, as it was for many companies out there, actually turned out to have a very silver lining to a grey cloud, because they ended up having, like I said, their most profitable quarter by just having that little bit of ingenuity and thinking, how can they turn on? Credit terms, and this goes both ways, from suppliers and to the customers. There has to be an assessment about whether the customers you've got are on appropriate credit terms. Is it worth having that one customer who always pays late, is always asking for an extension of credit terms? Are they eating up more resources in terms of employee time, bad debt, than actually you're ever really going to make back from them? It's a hard choice, because of course it's money going out the door by not committing to them anymore and not having them as a customer. But long term, are you going to be able to be in a better position by not having them as a customer. Additionally, suppliers, are you able to agree some sort of better credit term from your suppliers? Are they willing in this current environment to be able to better support you? I think that a price negotiation as well linked to that from any supplier has got to be a go-to in this sort of environment. Are you getting the best price? Are you getting the best service from your supplier? And link that to Brexit as well. Have you got a supplier that relies solely on importing? If that's the case, have you got a local alternative that could end up being a cheaper alternative in 6 to 7 months' time? Is now to take the step to a local supplier rather than relying on that import? Are they going to be giving you the preferred service in 6-7 months when we've got some sort of trade deal or not with the EU and we're on WTO terms? So actually you come out ahead by making that step now. Projections. Preparation. I think this is going to be the key point for a lot of companies out there. Do the companies know? Do you know about your company what your bottom line is in terms of takings over the next 3 to 6 months to make sure you've still got a company that is profitable coming out the other side of Christmas? It's going to take a little bit of time. It's going to take a little bit of work. But what is your worst case scenario? I don't think if you know that, how can you know what you need to be taking? How can you know what's profitable? How can you know what's a valid expense? I think the preparation for the next few months is going to be key. And then the last step here about practical protection, about the bounce back loan. I don't want to advocate taking on extra debt when you don't need to. But what I would say is that if we're looking at a situation where you're not sure about how strong your Christmas is going to be, or whatever your trading period, your strong trading period in the year is going to be, is a bounce back loan as a reserve sitting there going to be the best option for you? Could you use it as a pot to not necessarily have to dip into, but as that bounce back is going to be the best sort of corporate loan that you can get with interest frozen for a year as well? Is it worth having it there in reserve? Again, is it factored into that cash projection? Can you afford the monthly repayments? But if you are worried as a business that this Christmas may be weak, or whatever your strong trading period might be weaker this year as a result of COVID, it is a good reserve to have there to need to dip into should you. And I suppose just another point about practical protection. Landlord, is this the perfect time to be approaching them for a renegotiation right now? I know a lot of landlords out there are looking and having the conversations with their tenants at the moment about renegotiating leases, or just having a formal reduction in lease amount. So, it may well be worth approaching them at the moment to see what their appetite would be for a reduction in rent. So in terms of more formal procedures and protections for companies, there's a couple of different processes that I'll go through now, and for each of them I'll explain the actual process itself, and I'll sort of relate it to what I can see it being circumstance-wise to many companies out there at the moment, and how different types of companies can take advantage of these. So the first process is time to pay arrangements. These are sort of semi-formal arrangements with HMRC with respect to repayment of their debt. And the reality is, with the deferred VAT payment from earlier this year, upcoming corporation tax payments, it is likely the HMRC are going to be a material creditor of a lot of companies out there that haven't had the opportunity to recover from COVID enough yet to be able to afford that upcoming corporation tax payment, let alone afford all the ongoing costs and have to meet that VAT deferral payment by the end of the year. So what is the time to pay agreement? The time to pay agreement is effectively a monthly repayment plan over, I've put 12 to 18 months there, but 18 months is very much the longest I've ever heard of a company getting as a repayment plan from HMRC. It's much more likely to be around the 12 months, but probably maybe even less than that. What HMRC do, they take all the company's circumstances into account, and again, how they're going to react to COVID when taking time to pay arrangements into account. They're most probably going to be sympathetic to it, but they're going to be looking at compliance history as well. Does the company have a strong history of compliance, so they can have faith that the payments are going to be made, as well as making the other tax payments you have going forward. And the other point to make here is these repayments are going to be for repayment in full as well. So it's not a prospect to be able to say, look, I'll pay you whatever the amount's going to be to pay you 50% back over the next 12 months. They insist on payment in full. So a useful tool when HMRC are the only creditor or the largest creditor or potentially the problem creditor. But it is going to have to be for payment in full. So depending on the company's circumstance, that might be useful, or it may not even be an option in the first place. And I think the reality is, although HMRC have been quiet in terms of trying to go after repayments at the moment, there is a prospect here that in 6 months, when the visceral effect of COVID is a little bit less, the debt enforcement office are going to start taking steps. They are going to start going after judgments and winding up orders and issuing bailiffs to be coming to premises, because the reality is there is a big bill here to pay, and HMRC have to do their duty in terms of reclaiming that tax that hasn't been paid, to be able to get it back in and start repaying these amounts. So although quiet at the moment, I think HMRC will be stepping up their efforts in the coming months, maybe after Christmas, to be able to start getting amounts of money back in that are due. A CVA, a company voluntary arrangement. Now, this is probably, we're probably entering, if we weren't already, the age of the company voluntary arrangement, because effectively what this is the saviour process under the Insolvency Act for companies that can't pay their creditors as and when they fall due. So effectively, it's just an offer from the company to creditors as a whole about how they're going to be repaid, saying effectively, look, creditors, we can't pay the amount now, but what we can do, we can make a payment of X pounds for, however many months over the next few years, and that will repay you X pence in the pound. So there's 3 types of company voluntary arrangement. The first is, like I said, a monthly payment, usually over a period of 3 to 5 years. You've got a lump sum, which effectively would be, taking on some sort of consolidation loan, or, selling some bit of machinery or stock that's not used anymore and generating a lump sum like that. Or you've got a hybrid of the two. Again, it's going to completely come down to the type of company, how that company operates, and what industry it's in, to sort of know exactly what that offer could end up looking like. And the process itself is quite simple in terms of the CVA proposal is drawn up by an insolvency practitioner like myself. The proposal document, because of the sort of legalities it contains, is about a 30 to 60 page document. Again, depending on how much information is included in that, it's sent out to creditors and they vote on it. And you're looking for 75% of the creditors who actually vote on the proposal. So it's not 75% of all creditors, it's just those who vote to approve it. So if you've got £100,000 worth of creditors and only £1,000 vote and they vote to approve, that other £99,000 worth of creditors are bound to the terms of the arrangement that have been approved. And I suppose the other important fact to note here is that it doesn't have to be a payment in full. It can quite happily be, whatever the company's most affordable repayment is. So if it ends up being, 5% of what's due, 10% of what's due. I've even seen a CVA approved on 0.99 of a pence. So you're talking less than 1% repayment there, because it was the best repayment. And again, the amounts we're talking about in that case especially were ginormous. But the reality is it was the best offer that could be put forward. So it was accepted by creditors. So how could it be used by a company at the moment? Well, the reality is, I think we're looking at companies that are obviously have got debt amassed due to COVID and sat there. And obviously it's very sluggish trade coming out at the moment, trying to recover. But you've got some creditors that simply can't wait for that repayment, are having to take action, are having to chase. And the reality is that there's not probably 1 or 2 creditors. You're probably looking at many creditors who are starting to chase you. What you're trying to do is consolidate all of those creditors down to, say, the lump sum payment or 1 monthly payment, and formalize that repayment to them. And the other thing is that even if a creditor didn't receive a copy of the proposal or didn't receive notice of it, they're still bound by it. This is an Insolvency Act process. It's a formal debt repayment process and saviour process. So we're talking about something that is going to formally solve, as long as it's approved, hopefully the company's woes. And the CVA can be twinned with the next process we're going to talk about, which is one of the new ones that's come out of SIGA 20, which is the moratorium. So the moratorium is in itself not a process to save the company, but it is protection and a stepping stone to a process that might. So what is it? Well, effectively, it is a filing of documents into court, or a court application if you're not eligible to do the out of court, but it stops all legal processes against the company. It stops any winding up petitions. It stops any enforcement officers attending for a period of 20 business days. And that time will allow the company to either, restructure, refinance, or enter into some sort of CVA with the companies. But it's giving the company protection from those, so it can actually formally seek some sort of action to deal with the debt problems that it's got. Why has it been brought in? Well, it's effectively to give that breathing space, but it's also to try and give a competitor to US Chapter 13 bankruptcy proceedings, along with the other part under SIGA as well. This is just one part of the two processes been brought in, but it's trying to give the companies more of an ability to do it because it's a debtor in possession process. Now, what's that? That is effectively saying that the company will remain in the debtor's control. They will be the ones that are dealing with it, and it won't be for, say, an IP to come in and take over the running of it like in a CVA or an administration. The directors are the ones in control. So the moratorium is overseen by an IP who is called the monitor, and as long as the company is potentially going to be saved as a going concern, the moratorium continues. So just a little bit more information about the moratorium, because it's a new process. On this slide, I want to focus on the actual period of it, because although it's for an initial period of 20 business days, and like I said, it's now out of court appointments, so that's effectively a given, it can be extended, and it can be extended by the director without having to get the consent of creditors for another 20 business days. So you're looking at a 2-month period there where the company will be protected from any sort of action against it. That is with the caveat that the monitor has to be happy that the process to try and save it as a going concern is still likely. So there is a little bit of a barrier to getting into it, but I won't go into that too much today. Can also be extended with creditor consent, and if it's with creditor consent, then that's by a decision process. You have a vote on it, etc. That can be for a period up to a year, or again, a director can apply to court again for up to a year. The only other time at which the period would extend would be if during the moratorium a CVA was sent out to creditors to review and to vote upon, and the CVA date just happened to be outside the end date of the moratorium. It would automatically extend to that. And then just a confirmation of what the actual effects on the debtor company are. Ultimately, it's protection. Like I said, you're looking at protection from enforcement from a floating charge creditor, so no crystallization of their charges against company assets, so it keeps those assets with the company under their control. But probably more important for companies feeling the effects from COVID is there's not going to be any insolvency procedures being engaged against it. So you're not looking at anything like a winding up petition being allowed to be issued against the company, which obviously has damaging effects with a freezing of the bank account and stuff like that. So it gives the company a genuine protection, a genuine chance to try and refinance or go into a CVA or come to some sort of restructuring plan with the creditors without that headache of one creditor going off and scuppering the whole deal. The next process I want to talk about is one that you've probably all heard about because it's in the news all the time, and that's administration. Administration process as well. I'll do it from the point of view of a director. Effectively, it's quite an easy process, much like the moratorium. If you're eligible, you can just file the documents in court, or if you're not, you have to go to court with an actual application. And what's the effect of administration? Well, the moment those documents are filed in court, you get a moratorium against the company. So again, that stops any action against the company. It's automatic. Again, no enforcement officers can come around to the company and take any assets away. No winding up petitions can be issued, etc. why is that important? Well, the difference between an automatic moratorium under administration and the moratorium under CIGA 20 is that there's no barrier to entering into administration moratorium. It's a simple application for administration, and that byproduct is you have a moratorium. The difference is with the moratorium under CIGA 20 is that there is the barrier to getting in. To getting it, the monitor has to be happy that the company is likely to be saved as a going concern, and likely there is the problem term, because the monitor is effectively putting their license to saying the license on the line, to say that they have seen enough evidence that there's enough of a chance here that the company is going to be saved. So you're saying that sort of a refinance is already on the way, or there's already a sale pretty much on the line and going ahead, sort of thing. So administration is probably going to end up, if we're talking about how it's going to be used in the real world with COVID affected companies, you're probably looking at companies that have got pressing creditors that have not been dealt with for quite a while, and we're looking to protect the business and jobs no matter what the cost. And there hasn't been the chance already to look at refinance or sale or anything like that. The other way that administration could be used would be in terms of a pre-pack. Now, I know it's become a bit of a dirty term over the past 5 or 6 years, pre-pack, but the reality is, in this situation, if we've got a company that's been affected by COVID, why shouldn't the director try and buy back the company to continue it when it's had absolutely the failure of it's had absolutely nothing to do with the director? As long as they're paying fair value, it's a good offer, and it's unlikely there's going to be a better offer out in the open market, which probably is the case at the moment with COVID, because the market is it's not flowing as much as it used to be for businesses out there. There's potential for a lot of pre-packs to be done to save jobs and save businesses out there. So we'll see how that goes ahead, and may well be we're entering the age of the pre-pack administration again as well. So the other matter brought in by CIGA 20 is arrangements and reconstructions. Arrangements and reconstructions, the process, I'll quickly flip onto the next slide so we can see it, and I'll come back. But effectively, it's an application to court to summon a meeting. The meeting's then held, in which you need to get 75% approval, and that approval is only for creditors or shareholders, because it can be for either this proposal. 75% of those who would receive a return in a equivalent process, so something like a liquidation or administration. So if you've got a class of creditors that wouldn't receive a dividend in an administration or a liquidation, they don't have to be included in the vote. So assuming you've got 75% approval, you go back to court, another application to get the arrangement sanctioned, and then obviously once that's sanctioned by the court, it's in effect. So what's that like to mean for companies being affected by COVID? I've got to be honest, my initial reaction to the arrangements and reconstructions is that it's not going to be a tool used by the masses. There's more detail I can go into today, but the reality is, if you're a small to medium company, you probably don't have many different classes of creditors or shareholders or bonds, etc., that might be causing individual issues. The reality is you most probably just have unsecured creditors, maybe floating charge creditors as well if you've taken out some form of debt, and you probably have preferential creditors as well who are employees at the moment, but we'll also include HMRC by next April. So why would you go down the arrangement and reconstruction route when it includes 2 applications to court? It's a costly process, so I can't see it being used by many companies out there when the CVA doesn't include any applications to court and will allow you to deal with the majority of issues that you're probably facing as a small or medium-sized company. Now, again, it may well be that a medium-sized company does have a problem with one specific set of creditors that could be dealt with by this, but I don't see it being a much used process by the majority of companies out there. But effectively, if you were going to go down this route, it's a very flexible repayment tool. There's no real form about what it has to involve or what it has to include or even what the repayment has to be. It effectively can be used when a company is in financial difficulty or is likely to enter financial difficulty. So it could even be used as a sort of a foreseeing tool. If you know you've got a preference shares repayment coming up and you don't have the amount to meet this, you could be using this as a process to deal with those preference shareholders en masse. Without having to go to a CVA, or if you had bondholders and you had bond payments coming up and there's no way you're going to meet them, you could use this without having to go to all creditors at once and just deal with the bondholders as one. So yes, it will be used at some point, but the reality is here it's going to be used in very specific circumstances, and it's unlikely to be used by many companies, by the majority of companies. And just to come back here as well about the cross-class cramdown and relate it back to the start, this is one of the threats I think that a lot of companies could face in the coming months. So the cross-class cramdown, as I've said here, if you're not a creditor that's likely to get a return in an administration or liquidation, you don't have to be invited to vote on the proposal. So if a floating charge creditor, for whatever reason, wasn't going to receive a return in an administration or a liquidation, they could specifically be kept out of the vote on this arrangement or reconstruction, whatever it's going to be. And effectively, if it's approved and the court gives it sanction, the floating charge holder will just have to suffer that and just be a party to the contract they've had no ability to sort of have any say over. So what could end up happening is that as a company, if you default going forward, they're less likely to want to give you the ability to come to some sort of arrangement about how to rectify the default, because there's always the chance, if they let it go too far, that they could be stuck with a plan put forward by the directors that they didn't want to be involved with. So they may be looking to take control of situations earlier and therefore taking it out of the director's hands. So it's going to be important, again, coming back to those threats about keeping the secured creditors on side, so that they don't look to take unnecessary action if you are unfortunate enough to default going forward. I've put this in here. It's not obviously a protection for companies per se. However, liquidation can be used to save part of a business. The reality is it is the terminal option for a company. It is the formal closure option for the company. But the fact is, there's still the possibility here to save part of the business. The director or whoever can purchase part of the business back from the liquidation for value, so it's giving some return to creditors. But again, it may well end up saving a couple of jobs if the director is able to employ those employees in a new company. So although the terminal option for the company itself, the underlying business may well be able to be saved through a liquidation process. And how can I see this being used by companies being faced by sort of the impact of COVID? Well, if you've got a company that's not able to refinance for whatever reason, it's got creditors that aren't willing to entertain a CVA proposal, well, effectively what you're seeing, there's a position where a company doesn't have the ability to carry on trading. It has to take action in some way, because you don't want the directors being accused of some sort of wrongful trading by carrying on with a company that can't repay its debts. So close the company by way of liquidation, buy the parts of the business back that you want for value, and then carry on in a new company. Again, there's different restrictions, etc., around this, but this is very much an overview of that process. In terms of the actual processes, that's all that I've got for you today. So to summarize, there are many practical steps I think that companies can be taking now to try and protect their long-term future against the uncertainty we're all going to be facing going forward in the short to medium term. And I think coming back to that original slide, the one that I'd be highlighting most is the preparation. It's the cash flow projections. It's looking at what a worst case scenario means for your business, for your company. What do you need? Can you be using a bounce back loan? I think the reality here is you do not know until you've done those preparations. You don't know until you've done those projections. So it's about taking the time, again, probably time that people don't think they have at the moment, but it'll be important for their longer term future to take the time to understand exactly what their bottom line is and what they have to be achieving. However, I hope I've demonstrated today that as well as sort of practical solutions, there are more formal steps that can be taken by directors under the new SEGA parts brought in, and also a CVA. The directors can remain in charge of the process to try and save their company going forward, and hopefully have a long and prosperous future away from COVID-19. There's no questions in the chat box at the moment, so I will assume that I have covered everything as much as possible today for everybody else. If you do have any questions or want to speak about something specific, please feel free to give me a call. My number's there, or you can get through to me on the office line and just ask for myself. But yeah, thank you very much for your time today, and I hope you have a great day. Hopefully speak to you all soon. Thank you very much for your time. Bye-bye.